The Federal Reserve was created to regulate and control the monetary policy and money supply of the United States. In the over 100 years of its existence, the results of its policies have been mixed. Before the Federal Reserve, monetary policy was handled at the level of states and individual banks. Banks would charter through the state they were located in, and would have to meet the requirements of that individual state. This led to multiple currencies floating around the United States from different banks. Many of these banks were unstable, especially those in western states and territories, where a need for easy loans and cash flow was most needed. During the Civil War, the National Bank Act created a system where banks could be chartered through the federal government rather than state governments. The federal government began taxing the scrip coming out of state banks, which encouraged many to recharter themselves as national banks. This helped create monetary uniformity across the United States, making the flow of money quicker and easier. However, it also tied more banks together, meaning that a banking crisis would also impact more people and regions. In 1907, a bank run was triggered by a failed attempt by Otto and Augustus Heinz to corner the United Copper Company. Due to insufficient funds, the Heinz brothers were unable to accomplish their scheme. The United Copper Company, owned by Augustus Heinz, collapsed. This forced the State Savings Bank of Butte, Montana, also owned by Augustus Heinz, to declare insolvency. This bank had been using United Copper stock as collateral for its loans, which became worthless after the collapse of United Copper. This bank was a correspondent bank of the Mercantile National Bank, whose president was Augustus Heinz. Due to this association, thousands of patrons who deposited their money there ran on the bank to withdraw their money before the bank collapsed. This then triggered runs on other associated banks and trust companies, leading to a full-blown banking crisis. JP Morgan orchestrated a bailout with other big bankers and trust companies to stop the crisis. To avoid having to foot the bill himself again, JP Morgan met with other bankers, along with Senator Nelson Aldrich, to draft legislation for the creation of a national bank. In 1913, the Federal Reserve Act would be signed by President Woodrow Wilson, just in time for the world to plunge into war. During the 1920s, the Federal Reserve had an easy money policy. This allowed for large amounts of borrowing with low interest. Much of this borrowed money was used to invest in the stock market. This caused stock prices to rise. Inflation of goods was not felt because industrial output also soared, keeping pace with the increase in money supply. In 1927, a new Fed chairman, Roy Young, led the Federal Reserve in restricting monetary expansion after a decade. However, when the stock market crash came in 1929, this policy would lead to hundreds of banks shutting down after the bank runs. Fear of another economic downturn like the Great Depression has led to policymakers in both the government and the Federal Reserve to crafting policies to avoid that very fate. The 2000s saw record low interest rates for home loans, with certainty of bailouts from the federal government and the Federal Reserve. Banks and other financial institutions felt safe making ever greater number of loans to those who had been previously labeled as credit risks. These malinvestments created a bubble which eventually popped, triggering the financial crisis. Both the federal government and the Federal Reserve acted to stop a financial crash by bailing out banks and corporations. By June of 2010, the Federal Reserve had created $2.1 trillion with QE1. However, the economy was still growing slowly. In order to encourage exports, Fed Chairman Ben Bernanke approved another round of money printing called QE2. The plan was to encourage greater foreign investment into the US by devaluing the currency, which is easily done by money printing. In Currency Wars, James Rickards describes the events of a round of monetary devaluation between the US and China. The US managed to devalue its currency faster than China, resulting in US goods being more competitively priced on the international market. However, this results in everything priced in US dollars to become more expensive, including food. In the months leading up to the ousting of Zine El Abidine Ben Ali in Tunisia, food prices began to rise worldwide, especially in the Middle East, where food prices are always higher than the world average. The protests that eventually became the Arab Spring began as protests against rising food prices. The Tunisian government shut down the internet in order to disorganize the protesters. However, this move backfired, and protests grew even larger, eventually spreading across the rest of the Arab world. Rising food prices, whether caused by shortage of food or expansionist monetary policy, is always a motivating factor in revolution. Policies of the ancient regime in France that restricted the importation of food, along with a confiscatory tax system that disproportionately impacted peasants, was a driving force of the early stages of the French Revolution. World War I diverted large sums of food from the marketplace to the front lines in the Russian Empire. Along with this, the Russian central bank unpegged the ruble from gold and proceeded to print large amounts of paper money, leading to hyperinflation, which exacerbated the problem. Expansionary monetary policy always leads to inflation. And when the price of necessities such as food goes beyond the average person's affordability, violent revolution is all the more likely. The previous regimes in the Arab world were horrible dictatorships, but have the lives of the Arab people improved since the overthrowing and destabilizing? The policies of central bankers have a greater and faster impact on the world than those of the politicians that put them there. There is something that needs to be made abundantly clear. The Arab Spring, the rise of ISIS, and the new Iranian Empire are not the goals of the Federal Reserve. There isn't a vast conspiracy of international bankers in any form or incarnation trying to destabilize the Middle East or the rest of the world for their own gain. There is a far more important lesson to be learned here. All actions have consequences, intended and unintended. The intent of an action taken by a government or a central bank can be purely humanitarian, but still result in catastrophic consequences. What we must learn as policymakers and citizens is to learn from past mistakes and understand the possible consequences of current actions. This has been Connect the Dots, Episode 3, ISIS, Iran, and the Federal Reserve. Thanks for watching.